Parets here, and welcome back to Pardon the Price Action. I am joined once again and always by Steve Strazza. Let's kick it off. We've seen some strong rotation out of growth and into value to kick off the new year. How do you want to be positioned in 2022?
So growth versus value was kind of a mixed bag last year, right? And this first chart shows it really well. I'll let you expand on that more when I'm done. I have 2 points. Right now, when you look at the relative trends, especially for the large caps, focus on like the spiders, right? XLK is really the only clear one that's breaking out. The cyclical and the value sectors don't look as good. When we try to look at barometers of growth or value, so you could do that looking at the NASDAQ, treat that as growth, Dow, treat as value. When we look at the major averages, we're running into overhead supply. Some of that overhead supply is back from the dot-com bubble, 2000s. Other ones, if you look at like just growth versus value, the Russell 1000, we use IWF and IWD. They're running into their highs from last year after chopping sideways for a long time. And then let's think about what actually drives this trend. On a sector basis, it's really tech and financials is what it comes down to. The growth versus value ratio is trying to break out to new highs. At the same time, if you look at tech versus financials, they're putting in a lower high. I don't think that bodes well for the growth versus value trade. And then when we look at the absolute trends, a lot of the growthier stuff or the tech stuff has been getting creamed this week in the beginning of the year. And they just look toppy. You can see it in all these charts, whether it's ARC, software, internet. We joke internet stocks are trading like no one's going to use the internet again. Then when you look at the cyclical stuff, financials are working. Banks look great. They're finally participating, confirming what we're seeing from rates recently. Bank of America, beautiful chart. You've seen the same from materials. Energy just broke above its fall highs. So on an absolute basis, the trends there look a lot stronger. Gun to my head, I would want to be in cyclicals going into this year.
Yeah, and you want to know something, the small caps had already been telling you, right? So small cap growth had been underperforming that value all of last year, pretty much since the first quarter. It was really the large cap growth that continued to push up against new relative highs. And now I think they're succumbing to what we were seeing in the small caps. I just want to finish up and add to what you were saying. It really is the bond market that's been pushing around these growth value oriented areas, right? As interest rates are going up, investors are going to be less inclined to pay those high multiples for those growth stocks. And you're going to see rotation into areas that do well when interest rates are going up, particularly financials and energy, of which the NASDAQ has zero exposure to. So that's really what it is. And I just can't, it's uncanny. You're looking at the NASDAQ 100 relative to the Dow Jones Industrial Average. We are literally running into those March of 2000 highs. And when you look at the NASDAQ Composite versus the S&P 500, it's the same thing. Literally just now, after 20 years and change, finally getting back to those levels. I'm fascinated. Let's move on. Let's talk about some new highs.
So a big theme from the monthly call this week was new highs. You were all over these new highs. Tell me what you're seeing when you zoom out.
A lot of new highs. One of the things that we like to take note of is our behavior. The things that we're doing, the things that we're saying to one another, the types of words we're using. We do this so much and with so many people that you kind of start to notice trends of things that maybe we're talking about now that maybe we weren't talking about before, and we kind of use that as information. And one of the things that I noticed was catching myself writing new all-time highs, new all-time monthly closing highs in the S&P 500, Dow Jones Industrial Average, Dow Transports, new all-time highs across the board, NASDAQ Composite, even the mid-cap. So now you're starting to go down the cap scale. You're still getting new all-time highs. We didn't quite see it at the small cap level, but we definitely saw it in mid-caps and around the world too. Look at the World Share 5000 to finish up the U.S. And then, of course, Canada making new all-time highs, Germany making new all-time highs. And I know one of your personal faves, the stock market versus the bond market, really confirming that on a relative basis.
So just to add to that, it's not just the U.S. making new highs. When we zoom out and look at things on a monthly closing basis, there's a lot of new all-time highs in Europe and around the world too. I think what's super bullish is that we're finally seeing new highs from the stocks versus bonds ratio. High yield versus treasuries is another one that's making new highs. So we're getting it from our risk appetite ratios and from global indexes, not just U.S. large caps. I think that's really bullish. Some people might get picky and say, well, it's not really new highs if you look at a daily. That's fine. That's why we zoom out, is to put the structural trend, into focus or into perspective. And when we do that, we're seeing a lot of primary uptrends and continuation patterns.
All right, Strazza, moving on. We love our big bases here at All Star Charts. Is there really price memory going back all the way to 2000, though? will these patterns actually work? Is there real market memory going back that long?
So I'm gonna kind of just punt on this question and say I really don't care. I do have thoughts on whether or not there's price memory, but I really don't care because what matters most is that these patterns work, right? So I would liken it to Fibonacci extensions and Fibonacci retracements. A lot of time, especially when I was getting started with technical analysis, I didn't know what Fibonacci was, but I knew that it worked, and that was enough for me. And that's the same with these big bases, and that's why we brought some examples along. Morgan Stanley is a great example, breaking out back above those 2000 or 2001 highs. With a lot of the banks, you actually see them breaking out above the pre-financial crisis highs. This base is even bigger. With tech stocks, we brought along Micron as an example. It's all about those dot-com bubble highs. These bases, you've seen them time and time again, especially with the semiconductor stocks. When they go, you want to be a part of it. You want to be long. Ford is one that we've been talking about recently. Pfizer too. These are really nice charts. But I'll leave it to you to talk about whether or not there's really price memory there.
I mean, there's no question that there is price memory going back to the 2000 highs. Like I could tell you because I speak to the institutions themselves. You could see it in their holdings. So it's just public information that there's overhead supply there. Not to mention, you could just see it go time and time again back to those 2000 highs. Here we're looking at Pfizer. The market tends to respect those levels, number one. Go chart by chart. Not even the ones that we brought, but other ones too. And then go back to the 2007 highs, and you're going to see a lot of stocks and indexes, for that matter, running into those former '07 highs, struggling, and then look what they did when they resolved above that. And then more recently, the 2018 highs, January 2018, particularly internationally, that was a big pivot point there where a lot of stocks stopped going up, and then look what they did once they broke out. So you could really just see it. In my opinion, it's common sense, and I don't see any sense in continuing to argue for that. I mean, the data is right in front of us.
I mean, AMD is a great example. If anybody's confused, look at the chart of AMD. When this one went last year or the year before, oh man, this was a great trade for us. Just look at that, over 100% return since then. And one thing I would like to add is there's a lot of big bases right now when you look at the global indexes, whether it's emerging markets, ex-US, all country world index. They're working on these massive bases. If those things go, imagine what the implications would be for risk assets.
No doubt about it. All right, speaking of the world.
So, oh, lovely. What a transition. Heading into 2022, is it still US over world? Will this relative trend ever change course?
I mean, when you go chart by chart, this is the rest of the world outside the US versus the US. This is emerging markets versus the US here, making new all-time lows. Asia versus the US obviously looks terrible. Latin America looks terrible, whether it's compared to the US or on its own. Brazil, obviously. I mean, but when you look bigger picture and you're looking at things like Germany and you're looking at Canada making new all-time highs and in Europe in general coming out of these big bases, I think we could be in a situation where they can go up, right? But there's no evidence of a relative change. Like all the data to me and all of the components of what's in these international indexes versus what's in the United States points to this is the time for international to shine. But when you look specifically at the ratios themselves, we're just not seeing it yet.
Yeah, and that's a trap I've fallen into before. And I think we talked about this in the beginning of last year. Australia, Canada, Europe. I mean, this market is made for them. The reflation trade, financials, energy, industrials. This is all about ex-US stocks. But I think what it's really going to come down to is just due to the breakdown of the indexes in the US, all these charts we're using S&P in the denominator. So big cap tech, big cap growth have stopped working so well for these relative trends to actually start to reverse, I think.
Yeah, I'm really fascinated to see how this is going to develop throughout the year. See what I said there? Developed? All right.
Ooh.
Oh,
and those
all right. Autos are hot, baby. The automakers have been on fire, and it's not just Tesla. What's going on in automakers?
I just love this space right now. I think it's really exciting. It's also fun, right? Because you know me, I love a stock that people hate. Sentiment's very, very important. If you can find a stock that's really just hated, beaten down, whatever, these traditional automakers have been out of favor for so long, really since the financial crisis, bailouts and whatnot. It's over more than 10 years later, you're seeing some massive bases resolve higher. I mean, Ford is breaking out back above its 2011 highs. That was just, I tweeted at the CMT Association. I told them this one's for the textbooks. because that was just a high and tight flag right above the breakout level, resolved higher earlier this week. Looks great, but it's not just Ford. GM is breaking out of a massive base right at its Fibonacci extension too. Actually, go back to that one. So Ford on the breakout, we got confirmation from an overbought reading from momentum and new relative highs. There's so much to like about this chart. I just think people are very obsessed with Tesla. There's so many other options. You could buy GM or Ford or Toyota. It's not going to kill you.
Yeah, but Tesla was hot. You know what I'm saying? Remember we sold those puts at Tesla near the lows? Remember we were talking about putting on a risk reversal, and the risk was for a risk reversal was very aggressive. Selling the puts, I think, the way we did it. I mean, listen, we worked out, we made money, but yeah, I mean, it's unbelievable. Things like Toyota, because when you look around the world, you're looking at Japan breaking out of a monster base. Speaking of monster bases, is there a bigger base in Japan? Toyota gives you exposure to autos and the strength in that space, as well as the strength that we're seeing in Japan. I think that's an interesting combination.
Yep. And just to point out, these are risk-on stocks. These are cyclical stocks, automakers. So also bullish for the broader market.
All right.
So this is a game that we like to play where we say the first word that comes to mind. Today's phrase is inside information. What do you got?
For me, first thing that comes to mind is that it happens. People get inside information every single day. We can see it in the options data. We can see it when CEOs are buying shares of their own stock. They're using inside information to make those decisions. There's a million reasons why a CEO might want to sell his own stock or her stock, but there's only one reason why they're buying, right? It's because they think it goes higher, and they have to publicly disclose that. Nancy Pelosi was YOLOing some Micron. Speaking of big bases, maybe she has a technician on her staff pointing out those big bases. They have to disclose that inside information that they may or may not have. And you see it all the time. So, you see it illegally in the options market all the time. You see big splashes. Somebody knows something. It doesn't always have to be illegal inside information. Maybe they just know something that they're allowed to know that the rest of, your typical investor hasn't seen yet. Who knows? The point is they have good information. So it's not so much inside information as it is really, really good information. Sometimes legal, sometimes illegal. But that's up to the regulators. That's not up to me. We're just trying to see what's going on in there and try to benefit from it.
Whether or not they obtain the information legally or illegally really doesn't matter to us, right? It doesn't change the way that we can react to it. But we have so many tools at our disposal these days. Now that Congress people have to report everything in a stricter fashion, that's awesome. Like you just talked about Nancy Pelosi, but also like the Form 4s. We love the Form 4s. We've been tracking them internally, which you can see on this inside scoop table. And one that I'll mention that really stood out past few weeks was Ford. I think the CEO of Ford were buying millions of dollars worth of shares. Today or yesterday, when Ford really resolved higher, it was up like 12, 13, 14% on Tuesday or Wednesday. They dropped a press release. So don't think for a second that the CEO and the chairman aren't buying shares, knowing that they're about to drop a press release that investors are going to react very positively to. You see it all the time, especially pay attention when CFOs buy shares. They're the most in touch with how the market's going to react to certain reports or financial statements. So it's really good. There's information there, and it's nothing to complain about. It's fine. It doesn't hurt us.
Yeah. A lot of people are worked up that senators and reps shouldn't be trading, and, maybe they shouldn't. I don't know. It's above my pay grade, but they do, and they have to disclose it, and we can either take notice and see if maybe we want to invest also or not, right? That's up to you. We're going to take the data, and we're going to use it to our advantage, whether it's somebody in the House or the Senate or the CEO or the CFO. It's a great point you made. Or a few of these hedge funds also, by the way, when they're filing their 13Ds, I want to take notice. What's that biotech fund that just crushes it?
Oh, Baker Bros. They're so good.
Baker Bros. We want to know what the Baker Bros are doing with biotechs, right? That's how I look at it. All right, let's go. 2-minute drill. 2021 was all about the continuation patterns within the context of primary uptrends. Are these ranges ever going to resolve?
All right, so let's just take U.S. large caps and put them aside because they were actually the outlier in 2021. Is that fair, right?
Sure.
Most things went sideways. Sure, the S&P, the NASDAQ, and the Dow were working, grinding gradually higher, but this is really what's representative of 2021. Look at small caps bouncing around, the same with industrials. They were just stuck in a range. If you zoom out on these charts now, It's going to look more like Australia or copper and the global Dow. And it's really not just the US, it's international stocks, and it was commodities too. And that's why it's so important for us to zoom out, look at the structural trends, because these things are in uptrends. These are simply continuation patterns. What do continuation patterns do? They tend to continue. So I would be erring on the side that these will resolve to the upside.
There's no doubt about it. I'd also like to add that continuation patterns should resolve in the direction of the underlying trend. That's why they're called continuation patterns. Now, if they don't resolve in the direction of the underlying trend, it's not like, oh, JC, technical analysis doesn't work. It's like, no. If what is supposed to happen does not happen, that in and of itself becomes the signal. So if these continuation patterns do not resolve in the direction of the underlying trend, like, for example, U.S. Treasury Bonds on the long end of the curve in the summer of 2016, classic continuation pattern. It looks very similar to this right now, and they resolved lower. And that was information, and rates absolutely blew up from there. So that's information. So yes, the bet is these resolve higher, but if they don't, that is information.
See, I couldn't agree more. One thing I always say is that failed patterns are patterns too, right? When a pattern fails, don't throw it out. Get on the other side of it. It's nothing better than like a failed head and shoulders top, or when a bull flag fails or something. Another thing I would just say is we can take the weight of the evidence. We're very lucky because there's continuation patterns. There's just these ranges everywhere. Appetite ratios, whether it's stocks versus bonds, high yield versus treasuries, they're starting to go and resolve higher. So I'm asking myself, do the rest follow? I think we're starting to see that. So,
all right, final word. What are you going to leave the folks with?
You know, just something we were thinking about. We were talking about Aldous Huxley, Willie and I, on the morning meeting. So something that's happened with the digital revolution or the information age, people call it all sorts of different things. Basically, the information playing field has been flattened, and that's only going to continue. So information, data, knowledge that we didn't have maybe 10, 15, 20 years ago, most people have access to today. I think it's going to become, it already is, a very rare and valuable skill to be able to decipher that information that you don't need to know from the information that you do need to know. Otherwise, you're going to really just paralyze yourself with information overload. So I think that's an important skill to kind of adapt to.
All right. Well, I mean, you took my thunder completely from me. I don't have anything, that important to our day-to-day lives. I was just, I was really feeding conch fritters and stone crabs this week. Growing up in Miami, we're right in the heart of stone crab season.
Yep.
I mean, it's, boy, what I would give for some conch fritters and stone crabs right now. Maybe some key lime pie. A nice Sauvignon Blanc. Watching the sunset down in the Keys.
Takai.
With a Takai, I mean, now we're getting aggressive. That's my move when I go to Joe's in Miami. But down in the Keys, those things are harder to come by. But if you can somehow get your hands on some good Key West conch, get some good conch fritters, and get some stone crabs, or if you're down in Miami, head over to Monty's. Love Monty's, love Joe's and the beach. Shout out to the tavern. What's the name of the tavern? Captain's Tavern in Pinecrest in Miami. Great fish market. Shout out Captain's Tavern. Love that place. If you can't make it down to the Keys or you don't want to go to Joe's, Captain's Tavern will get you done.
Well, don't get mad at me, but I might just walk across the street and get some of them.
Oh, stop. On that note, I'm going to go to Gold Belly and order from Stone Crabs. Everybody, thank you for watching. Give us a like, hit the subscribe button so you never miss an episode, and make sure to follow me at All Star Charts. Follow Steve at Strazza. Leave a comment below. Let us know what you think. Let us know if you have any questions, and we'll see you next week.